Hi everyone, Lukasz Kalwak here from Franklin Templeton Institute. Markets never sleep and neither do the opportunities they create. So let's dive into what's been moving the markets lately and what it all means for your portfolio. Of course, the big news is that President Donald Trump signed legislation to end the longest government shutdown in US history, marking the official conclusion to a 43-day impasse. Trump's signature means the government can begin to resume normal operations, with federal workers expected back on the job starting today. That's a positive news for the economy and for equity markets. Why? Because during the government shutdown, the US Treasury built up roughly $1 trillion in its cash account at the Federal Reserve, known as the Treasury General Account or TGA. This is what the chart shows. It's essentially the government's checking account. When it rises, money is pulled out of the financial system. When it falls, that cash goes back in as the government spends. With the shutdown now over, federal payments and contracts can restart, meaning liquidity will flow back into the economy. That's positive for risk assets as it eases funding conditions and supports growth-sensitive sectors. The pace at which Treasury spends this cash will determine how strong the short-term risk-on response is. In January 2025, we published Get Ready for a Broader US Equity Market, in which we demonstrated that lower interest rates, solid economic growth, and ample liquidity have historically supported broader US equity market leadership. And here we are in mid-November, and market performance has largely shown this call was accurate. Throughout 2025, central banks globally continued to ease policy. US GDP growth remained robust despite ongoing trade tensions, and fiscal stimulus in both the United States and the Eurozone sustained strong liquidity conditions. The result was a bull market, with all major US equity indexes reaching record high levels this year. However, this bullish price action was not only limited to the United States. See the chart. In 2025 alone, 35 countries represented in the MSCI All-Country World Index have posted new one-year highs, the best result since 2018. This means that roughly 75% of countries globally have enjoyed bullish price action. Despite the solid gains in global equity indexes, we continue to believe that conditions remain favorable for further broadening of market leadership. The US economy remains resilient, underpinned by robust consumer spending, with the latest real GDP estimate at 4%, one of the strongest readings in recent years. We expect Fed to continue lowering rates as it focuses on labor market conditions, contributing to a further easing of financial conditions. Historically, this combination of solid economic growth and easier monetary policy has provided an ideal backdrop for corporate earnings expansion. We are already seeing this dynamic unfold as forward earnings expectations for the S&P companies are rising sharply, reinforcing the case for an earnings-driven bull market. See the chart. Bottom line, as long as earnings are resilient and liquidity is supportive, trend is your friend, and we think it's prudent to buy the dip and stay on course.